GORV, the GORV company, and TSSI TSS Inc. are both examples of what you might call deep speculative stocks companies that exist outside the mainstream radar of Wall Street analysts and institutional investors, and as such, they present both unique opportunities and significant risks for anyone considering a position. Starting with GORV, the GORV company, the lack of recent analyst coverage or detailed financial reporting is itself telling. When a company is this far off the grid, it usually means one of a few things. It could be a very new listing, a micro-cap with minimal trading volume, or a business operating in a niche sector that simply hasn't attracted much attention. In the case of GORV, if you're thinking about investing, you're essentially flying blind. You won't have the benefit of consensus estimates, Wall Street research, or even much in the way of reliable third-party data. This means any investment decision is going to rest heavily on your own due diligence, perhaps a belief in the management team or a thesis around a specific catalyst that could drive value, such as a turnaround, acquisition, or industry shift. The risks with GORV are substantial. Stocks in this category are often subject to extreme price swings on low volume, making it easy for even small trades to move the price dramatically. There's also the ever-present danger of dilution, as companies at this stage often need to raise capital to fund operations, which can erode shareholder value. Regulatory risk is another factor. If the company fails to meet exchange listing requirements, it could be delisted, which would severely impact liquidity and investor confidence. Unless you have a very high risk tolerance, a clear and well-researched investment thesis, or some kind of edge such as industry knowledge or access to private information, it's generally wise to treat GORV as a speculative flyer at best and not a core holding in any portfolio. Turning to TSSI or TSS Inc., there's at least a bit more to go on. The company has a market capitalization of roughly $226 million, which puts it squarely in the small cap category, and it reported trailing 12-month revenues of $148 million with EBITDA of $9 million. At first glance, those numbers suggest a company that's generating real business, but a deeper look raises some flags. The price-to-earnings ratio is sitting at a lofty 37.6x, which is expensive for a company with modest growth prospects, and the debt-to-equity ratio is a staggering 50x. That kind of leverage is a major concern. It means the company is heavily reliant on borrowed money, which can amplify both gains and losses, but also leaves it vulnerable to any downturn in business or tightening in credit markets. Looking at the stock's trading history, TSSI is highly volatile, with a 52-week range stretching from $1.25 to $18.26. That's the kind of price action you typically see in penny stocks.